One of the big issues between UK and Europe since the Brexit vote has been London's domination of the euro clearing market. Europe is considering moving some of it back to the European Union in order to have more insight over it. With me to talk about this issue is Daniel Hodson, chair of the FSNForum, a group of city practitioners, and former director at LCH ClearNet, a London clearinghouse. Daniel, welcome.
Thank you.
Let's just set the scene here.
Yeah.
This is an indication here of London's dominance, and pretty complete over the rest of, well, most of the world here.
Yeah.
Now, some people don't want this to change, but does Europe have a point here?
Well, I think with Europe's view, the EU 27's view, let's put it that way, is that they consider there to be a systemic risk if they don't have an appropriate amount of control over euro clearing. And I can understand that. The difficulty is actually in trying to move it, because for all sorts of technical reasons, you could end up in a situation where you create an even greater systemic risk if euro clearing were to be disaggregated out of London and moved over to a series of EU 27 capitals.
Do you think there's an issue here about wanting to maybe control margins that are set in clearing houses?
No, I don't think so. I don't think it has to do with that. That is getting too fine, but you're right about one thing, and margins are a very important part of this. The whole point about clearing is that it's massively complex, all sorts of currencies, all sorts of products. And what happens in a clearinghouse is that the exposure is netted down to an extent where you have what's called cross-margining, and the cross-margin is at a very low rate because of all the offsets. If you take a great chunk out, like euro clearing, you increase the margin.
Right.
So you increase the margin not only in the London clearinghouse, but you also have to increase the margin elsewhere. And it is very complex, and believe me, margining is hugely technical, and it would be a complete disaster if governments got involved in that.
So let's look at the potential options. One is that the European Union just recognises the UK as is.
Yes.
Do you think that's likely?
I think it's probably quite unlikely. I think there are good reasons for arguing that they should, but I think it's unlikely, politically.
The second one is maybe to consider relocating euro-denominated business into the European Union. Now, if you did that, what would be the effect of something like this? This is business in euro-denominated swaps in the US. That's an issue, isn't it?
Well, it is an issue, and there are also, you raise a whole lot of counter issues as well. I mean, to do that would be a protectionist issue, which would diminish the status of the euro as reserve currency for a start. It's certainly going to upset the Americans if that happens. But interestingly, the regulatory supervisor of the derivatives market in the States, the CFTC, actually has an arrangement with London, with the London clearinghouse, and indeed with other European clearinghouses, which enables them to, in effect, have a degree of regulatory oversight. And that actually works. And in fact, you could do that under these circumstances by having a similar arrangement out of the EU 27 into London. No reason why it shouldn't be done. It's practically speaking, but is it politically possible? That's the big question.
Final, very quick question then. Do you think that will be the outcome?
I think it is quite possible it may be. I think if we get to successful negotiations, issues like this, which are economic in nature, but at the end of the day have to be settled on a political basis, are things which are capable of being solved. My own personal view is, and this is a personal view, is that it probably has to do with a large check. But I certainly think that political issues can be solved. But at the end of the day, as I say, economically, it doesn't make sense. Politically, it's being driven, and it has to be solved politically.
Daniel, thank you.
Thank you.